Good morning, everybody. Happy New Year. It is New Year's Eve, 2021. So I thought I'd go through my futile forecast and I'm going to review a few things. As you can see, I'm wearing a sweatshirt. My girlfriend and I have different ideas of what the temperature should be in the house. I generally lose, so I wear a sweatshirt. This is actually my normal uniform, is what she calls it, sweatpants, a t-shirt, and a sweatshirt. I moved away from suiting up about 5 or 6 years ago. I was ahead of the curve when I closed my office in Elm Grove, Wisconsin, and now I work from my lovely library. Actually, that is the virtual version of my lovely library, but that is about what I want it to look like because we are looking at land so that we can build something. We will see how that turns out in the next couple of years. Until then, you get the fabulous green screen library room. I wrote this article. You can see it on the screen. My futile forecast. Talk about the dollar, stocks, REITs, crypto, inflation, other crystal ball stuff. I went through some of the past things I said, and one of the commenters has already called me out for a while. You just post the things that you were right about. Well, I'm right about everything, so why wouldn't I? Now, actually, if you see the bullet points right up on top, I talk about forecasting. You're not really doing forecasting because you think you're going to be right about everything. You're doing forecasting so that you can prepare for what other scenarios emerge. And if you have thought it through ahead of time, rather than being knee-jerk as the narrative news hits you in the face from your screen and your cell phone and the breathy heads on finance media TV, and then you can control your emotions and have a real good idea of what you want to do as things develop. Now, you're going to want to have quite a bit going on from the point of view of, what is my plan? But plans need to remain flexible. We don't want to trade a lot in most cases unless you are specifically out to swing trade. But if you're not a swing trader, then you should not trade a lot. And that's really where having a good fundamental analysis within the big secular trends, understanding the government policy, and then just getting a good technical read on about when to enter. And that's the summary of our 4-step process. Identify the secular trends, bet on the upward secular trends. Don't get involved with the downward ones. If you want to bet on the downside from time to time, again, you'll be a swing trader, and you have to have very good technical skills to do that. Second thing that we analyze after the secular trends is what is the impact of the central banks and the Fed in particular and government policy. That's important because the Fed does directly affect the stock market no matter what anybody else says. The problem is there's often a time lag, and measuring that time lag comes into the whole analysis of liquidity. And that's something that we'll take a long look at as we go into 2022. As the Fed pulls liquidity out of the market, how much of the excess liquidity that's already in there can keep pushing certain things up. And I have a thesis that I think is going to end up being right. That is the Great Divergence. I think you're going to see money go in the direction of higher growth companies, higher quality companies, and this whole everything in the index goes up that's been going on for 18 months now will come to a pretty abrupt end. And we are going to see a sorting out of the companies in the S&P 500 that really don't belong in the S&P 500 anymore. The third thing that we take a look at, obviously, is industry and company fundamentals. That's extremely important. Obviously, you don't want to invest in, if you're a Reddit reader, this isn't defensive. Shit stocks. You don't want to invest in shit stocks. Unfortunately, probably 40 to 60% of the stocks in the stock market are, not worth investing in ever. Not even through high exposure in ETFs. There are quite a few companies that I'd call average, and there's only maybe 1 in 5 that you should even think about owning the individual stock. And I want to really hammer on this point in 2022. I mention it, but relative performance is the only reason to invest in a single stock. You're not investing in a single stock to get 1 or 2 percentage points more than the index. There's no point. You don't have a very large margin of safety when that's all you expect to get from taking on all that single stock risk. If you're going to take on single stock risk, you need to have the chance to really beat the market handily 10, 20, 30 points over a few years. And that's just not many stocks. You're better off owning a good basket of ETFs in the right industries and the right indexes with the right managers in some cases than you are picking out stocks. I'm taking 5 stocks off of our REIT list because they haven't overperformed the market for over a decade, and they're not going to. And if they can't outperform the market with interest rates at 0, how are they ever going to how are they ever going to outperform? I know there's people in love with REITs, but there's a lot of reason to look at that particular subsegment of the market right now and just go, this sector has got a lot of risk, especially if interest rates actually do go up a point or two. Finally, the last thing that we look at after the secular trends and policy and the fundamentals is the technicals and the quantitative analysis. I have made a point of being a quant 16, 17 years now, to the point where when headhunters used to call me when I was a younger man, that's what they wanted to know. Can you come to this firm out in Stanford or Boston or New York or out in San Francisco and be a quant for them? And I said I could, but I'm raising my kids here in Milwaukee. So unless you can do it remotely, I can't do it. Well, back then, remote wasn't a thing. Today, I suspect if I called a headhunter, I could probably get some pretty good remote opportunities. But then I sit there playing with numbers all day and factors rather than actually getting to know the companies. And I enjoy getting to know the companies because I'm pretty close to becoming an active real estate development guy and angel investor. So why don't we dive into this article, just go through it real quick. This is one of the most important charts that we need to always pay attention to, the hype cycle. And this one has to do with technology right now, but there is a lot of reason to attach this to almost any company. And if you can't invest down here, which is hard to do, we're trying to do it right now with a bunch of the SPACs that are just beaten to oblivion and some small caps, or here after they come down, and you can go through the carnage and see, okay, who are the winners going to be? Those are the 2 real spots to invest. And this is the one that most people get in on. Now, the problem is they see this big run up, comes down here, and you go, oh, look at that, it's a bad stock. And people don't get to know the company. And right now, there are a lot of companies in the mid-cap space. Teladoc, I guess maybe is a large cap now, but there's a lot of companies that are coming off of the hype and are down in here. And we need to take a look at, okay, what are these companies really worth? And if you want something that's a little bit bigger, a little bit more established, this is where you need to look. If you're looking for 10 baggers, you have to look over here. And unfortunately, this comes with a little bit more risk in the short term. But if you pick your companies out well and you get 2/3 of them right or 60% of them right, and you cut your losers relatively quickly, and quickly not based on price movement, but based on lack of execution, bad luck, bad accounting, whatever the case might be. Don't make your decisions based on, oh, look at the volatility. Volatility is bad and I hate that, so I'm going to sell it. No, take a look at the company and say, okay, is this just the market being schizophrenic, which it generally is, or is this the opportunity to add more than I'm looking for? And if you know your companies, if you're studying the presentations of the company, and I really do encourage you to listen to the conference calls, then you'll know. And if you're only investing in 20 to 30 companies, which is what I advocate, and then have some ETFs for the rest of your asset allocation, you can put that kind of work into it. Now, do I expect you to read all the industry mags like I'm doing? Do I expect you to, use an AI to comb through all the filings? No, I mean, that's what you're paying me for, so I do that. But you should know enough about your companies from some of the presentations they do and the calls that they make, as well as their investor presentation, just so you know, okay, this is what they're working towards. And then you can monitor, are they making progress? Are they really getting the growth that they are saying that they're going to get? It's a way of benchmarking the company rather than just looking at red and green numbers on a screen and going bad, good, bad, good, bad, good. You're never going to be a good investor if that's how you do it. Focus on the companies, focus on what they're doing. Is their total addressable market really big enough for there to be money to be made? Are they going to get a big enough share of that to be able to pass on some wealth to shareholders. And ultimately, you should do pretty well. Now, if you add in the technical and quantitative analysis and this whole new meme creation cycle that's out there, you can maybe find a few extra home runs. We have a few stocks that I think the millennials are going to grab onto, and there's already signs of it on Reddit and Robinhood and rest of the social media. So we put that into our analysis, say, okay, this is a stock that the millennials might like. And I'm just going to skip through a lot of these things, but I encourage you to read the article because, if you do follow along, right, you don't just look at things as a point in time, but you kind of follow the story that I'm telling, you come out with a pretty good view of the world, I think, and you start to understand, okay, why are things working the way they are? I am going to stop here just on the Fed real quick. We know that money supply and debt have a relationship. So in this chart, the blue line is debt, orange line is money supply. And this is the relationship going back to 1970. See that debt was growing faster than money supply. Now, by the dot-com crash, the two were basically moving pretty close together. And lately, money supply growing faster than the debt. I don't expect that to hold up, but there are some reasons to believe that this in the short term has been very good for us and very good for the markets. As this orange line flattens out, and pretty much has to if you want to avoid inflation for the long term, and this explains a lot why we got inflation here for the last year, we'll see these two lines converge again. What does that really mean? Well, it means that this line, which has been tailing off for a decade, might level out again, might move sideways. So we'll keep an eye on that. One of my theses is that in the very long run, in a post-oil world, which we are approaching much faster than people want to say, we are going to be at a point that the United States doesn't have to worry too much about where it gets its energy from. So in an energy independence world, who are the big winners going to be? Well, the big winners are going to be where the consumers are, where the job creation and stronger economies are, where there's rule of law, where violence is low, where there's no wars, where there's food. And the United States really, from a geographic and diplomatic and economic and political and military standpoint, checks all the boxes. So the United States is going to remain very strong in this world where energy independence is developing, really first for the United States and a few, producing countries. But in that world, I have said that I think the United States can become a gigantic Switzerland. And what do I mean by that? What I mean is that there's really no reason for the dollar to collapse. We don't want it to collapse. And in a world where the import-export equation is changing, where it's not just based on cheap labor, it's based on quality, you're going to have a market where necessities and high tech and high skill become much more valuable. They've been watered down a bit. That sounds weird, but it's the case. So in the future, I think you're going to see the dollar maintain a higher range. It won't be too high because we don't want to crush everybody, but you're essentially going to see the dollar stay relatively firm. During an era with low interest rates, and that means our wealth is going to really accumulate because we'll be able to consume with that strong dollar at the same time that we're exporting the higher quality things, the higher margin things at a higher price, right? Dollar's higher. That means the price is higher to foreigners. We'll have to manage it because, again, we can really destroy the world economy if we just get too strong and too big. That's one of the reasons we've run so many debts, is because it held the dollar back. The underlying strength of the dollar is so enormous that if we don't hold it back through debt and money creation, you'd really just see the emerging markets never emerge. China would have gotten crushed. It really just would not have been good for the world. So that Goldilocks range that I've showed the charts on a number of times is ultimately where we have to focus ourselves. I really have a very bullish view of where America's going. So while I talk about markets that might get beat up and how to manage risk, that's just the right way to invest. You don't go into investing thinking everything's going to be great. I can just throw a dart at the dartboard and it'll go up. In the last couple of years with the QE, you could. And really, a lot of people for the last decade who think they're great investors have had the Federal Reserve at their back. With the Federal Reserve not likely to do the same type of stimulus that we just had again, unless there's a major crisis, there's going to be more price discovery. And the world is changing so fast that when you take a look at it, you see that the S&P 500 is 40% technology now. And yet there's a lot of people who keep talking about, well, I want to buy this, I want to buy that, I want to buy the other thing. And their technology exposure might be 20 or 30%. Let me ask you something. If technology is always a top 2 or 3 sector, very often the top sector, why wouldn't you want at least 40% of your money in tech? Why wouldn't you actually want more like 60% of your money in tech? More set up like QQQ. So one of the reasons that QQQ outperforms over and over again is because it has a better asset allocation than SPY. QQQ is what, 60% tech, and then consumer, and then some DeFi and some biotech. Those are the places where there's growth. That's where the most money is accumulating. So if you want to make money, go where the money is. Pretty simple concept, right? Follow the money. And I say this because everybody's telling me about, well, I want to look at this oil pipeline. No, you don't. I want to look at this REIT, this residential REIT. Not really, you don't. I want to look at this mall REIT. No, you don't. I want to look at this thing or that thing or the other thing in some crummy industry because I know what it is. No, learn about something else. And I can't stress that enough, because in this great divergence, that's coming, it's a great part of editing, we are going to see a lot of change. This is probably the most important section of the article. And if you ignore it, you're going to trail and you might get hurt. The millennials control a lot of the market now, and they're going to be a part of this, right? Millennials control a lot of the market, whether you like it or not. And their views and their money and their income, which is growing, are going to push everything. They're the biggest contributors of new money to the market now, right? They don't control the most, but they will eventually through earnings and through inheritance. And frankly, they're better traders than the boomers ever were. So as the great transfer of money, which is something that the financial industry has been telling us to focus on for a decade or more, occurs, and it's at the very front end right now, you're going to see more technology, more sustainability, and less of the things that you think are going to be here forever, because they won't be. So let's talk about oil for a second, because I talk about it in the article. The problem with oil and gas are that we know they are at the front end of long-term declines. Oil is closer to outright decline than natural gas is, but natural gas, by 2040, demand will be falling, might be sooner than that. Oil demand will probably start falling 7, 8, 9 years from now, by 2030-ish, a little sooner. And how can I say that? Well, oil demand growth is under 1%, and it has been for a long time, about a decade. Fuel efficiency goes up. Now we have more ride sharing. There's fewer people driving to work as the hybrid work model emerges. And this isn't temporary. This is permanent, and it's going to spread. So as your old line managers who want to keep you under their thumb by hovering over your shoulder disappear as they retire, you get newer managers who are Xers and millennials. A hybrid work schedule virtually anywhere that doesn't need labor, physical labor, is going to become hybrid. And a lot of people who provide services, they might not even have an office. I don't have an office anymore. I'm just looking to have a real nice library and office in my new home. So this transition is real and it's permanent and it's not going to undo. So fewer people are going to be driving to work. And when they do, it's going to be in a more fuel efficient car at a minimum. And pretty soon it's going to be in an EV. So let's talk about clean energy stocks. And by the way, somebody didn't know what this meant. Just mentioned weed as an investment. I said buy a towel and a weed ETF. If you're a South Park fan, you know what that means. From an investment standpoint, I know there's a lot of people who try to throw out some morality. Here's the thing. If you've ever invested in an alcohol stock, then there probably shouldn't be any problem investing in cannabis. If you've always avoided alcohol stocks, okay, then I get it. But the cannabis stocks are so beat the heck right now. They are at the point in the hype cycle where we just have to separate the winners from losers now, because the hype is gone, and it's been gone for a year. And these stocks are often down 50, 60, 70, 80%. That's the blood in the streets that you're looking for. So we are getting involved in YOLO. because it's the broadest index of marijuana and weed stocks and things that are related to those industries. And then CNBS, which is run by Tim Seymour, who I think is pretty good at this. So you have two options. You can split up your money, or you can, just pick one or the other. But I think having a little bit of both is probably a good idea. Some managed, some passive. And I think you have a good experience. I think that industry, as it becomes more legal and more federalized, especially through the financial system, so these companies don't have the impediments that they've had, a lot of these stocks can gradually get back to their old highs, or at least halfway back, which is still a triple or quadruple in many cases if they're down 70, 80, 90%, right? So, keep that in mind. Back over to the clean energy stocks, we are seeing that PBW, which is kind of our proxy, is one wave down and into its third wave down. It's going to end up in here somewhere. I don't know if it's about to stop. I don't think it is. But I think a price in the 60s, maybe the 50s, is what we're looking for. And why do we want these stocks, and why this particular fund? Well, this particular fund, while it has a lot of solar, it is more diversified than that. And they get more into the efficiency and the batteries and other items that aren't just solar. And I think it gives them a better diversification. And when you compare it to the solar ETF, TAN, they basically perform about the same. And this one has a little bit less risk. So there you go. Now, can you own TAN? Can you own the solar ETF too? Can you trade it? For sure. That is something that you can really buy on the dips. And if you need a trading vehicle, I think it's a fantastic trading vehicle. If you just want to buy and hold it because you're gung-ho on solar and you want a more focused bet, I get it. But I don't know why you would do that if you're a longer-term investor. If you're a longer-term investor, this is the fund. And there's a couple that are similar, but this one's been the best one for a while. The curve, you started to see it in here, is going to be like this. So it's going to end up back up here. It'll set new highs 4, 5, 6 years out. And if you can get it down here, obviously lowest cost basis wins. So that's what we're looking for right now. Right now, we know the secular trend is on its side. We know that government policy is on its side. We know that a lot of these companies are becoming profitable. So the fundamentals are on their side. And now we're just looking for the right technical entry price. Somebody asked about Chinese stocks. I have a very hard time investing in any individual Chinese stock because I don't know when President Xi is going to wake up on the wrong side of the bed and say, oh, I hate this billionaire and I'm going to send them away and take a third of the company and give it to some other company that a Politburo member is running. It's just not worth the risk. That said, if these Chinese stocks sell off into the first quarter, which I think they might, and you get 2015 prices again, and we've been through the whole idea of where the market is longer term. I have a couple charts in here. I'm not going to show them to you today, but we know that I have been talking about the market being baseline 2015-16. I think it's very difficult for the stock market to go below that level, but it can approach it in a very Armageddon type scenario. While in China, they're getting that Armageddon type scenario. Their finances are all whacked out because of the finance and investment vehicles. You've got the government cracking down on their big tech stocks. But ultimately, the big tech stocks are going to have to lead them because, again, just like in America, those are the ones that are printing the most money. They're the most important. They'll be a little bit under the thumb of government. But ultimately, growth is growth. The proxy over there is Alibaba as the biggest cloud company and biggest e-commerce. They're not dissimilar to Amazon. They're not exactly like them, but they're fairly close. And if that particular stock pulls back, I'm not saying buy it. What I'm saying is use it as a proxy when to enter a basket. So whether you're going to use EMQQ or KWeb, use Alibaba as your proxy. Once Alibaba bottoms, that's going to be the time to buy those ETFs. You get a basket, and then you can take part in the consumer transformation in China over the next decade, which has already started, obviously. The dollar we already talked about. This is the Goldilocks zone between the two yellow lines. If we fall down here, that's a warning. And if we fall down here, we're probably in crisis. This is what we really have to think about is, could the future look like a dollar way up here? or $1.10, $1.15, $1.20? I think yes, but probably not until the 2030s. So I think you see jitterbugging in here, some cycles within the trend. But the new secular trend for the dollar, which I identified on Market Watch way back in 2012, when everybody said the dollar was going to collapse, I said it's going to go on a long-term bullish run. What have you seen so far? 9 years of the dollar being strong. The dollar is going to keep getting stronger, and it'll jitterbug along the way. I think ultimately in the 2030s, you see it up here again. Crypto. Most crypto will go to zero. That's just the way it's going to happen. It's just like any industry that's getting a lot of hype, a lot of speculation. You know, you can go online and create a cryptocurrency in a couple hours, right? There's tools out there to do it. What gives any of those any value? And when I take a look at the dog coins, you know, this Shiba dog, that Shiba dog, some other guy's dog, my dog, your dog. When I take a look at all these dog coins and other types of coins, but the dog coins in particular, that's where shitcoin really comes from, right? You know, they're just not worth anything. Bitcoin, Ethereum, and a few others, though, are going to survive. Why is Bitcoin going to survive? It is digital gold. That said, what has gold done over the last 30 years? It's had 3 big rallies and then long periods of consolidation. Bitcoin's not going to be much different than that. I don't know how high the rallies are. Dr. Sean Stein-Smith, who I'll be interviewing for the second time on Thursday night, thinks that Bitcoin will go to about $100,000 next year. I'm not so sure if I agree with that. If I are a gambling man, and you know that I am, I would take the over. I don't think Bitcoin will get to 100,000 until 2023 or 2024, but it'll get there. During the summer of 2020, I told you all to take some of your bank savings and buy Bitcoin and Ethereum. Don't use your investment account money. Don't use your stock account money. But the money that you have saved in your bank for a rainy day, Bitcoin makes a lot of sense. Why? It's a hedge. And it's probably early in the cycle, so it still has upside. If you had bought Bitcoin under 10,000, which is when I told you to buy it, July and August 2020 videos, right, you'd be 5x your money already. Beats the heck out of a bank account, doesn't it? Even if only had a couple percent. So on the big corrections of Bitcoin, you should take some of your bank savings, the money that you just keep rolling over in CDs, just sits in a money market account perpetually, that money. Take a hunk of that and buy Bitcoin. Use Coinbase or whatever you want to use. I use Coinbase because of scale, because I think that they're the leader in the market. There's going to be others that catch up and fine. You can say this fee, that fee, whatever. The fees are all going to narrow, so I don't worry about the fees long term. Just like the brokerage industry, fees in crypto are just going to keep coming down, right? What do you pay for a trade now? Either zero or about $1. Same thing's going to happen with cryptocurrency. I don't think it'll ever be free, because I don't think there's a way to monetize it the way that we do stock trading, but maybe there is. I don't know. Somebody will probably invent it. So I like Coinbase. I think it's probably, it gives me the least amount of willies. I trust them. In fact, they're on our investment list for stocks. Ethereum, on the other hand, is not digital gold. It is the foundation for building digital contracts, which I've talked to you about before. NFTs, not fungible tokens. Right now, people are buying and selling images online, just created stuff, art, whatever. It probably doesn't have any long-term value. But what if you could use a digital contract based on the Ethereum blockchain that gave you a share of ownership in the Mona Lisa or the Empire State Building or a real estate development that maybe some of you know is going to be doing, rather than having to go through all the other channels that cost a lot of money, require all types of title work? What if digital contracts become so easy to use and so cheap that they revolutionize collectibles, real estate, banking, all sorts of things, anything that is contract based? That makes Ethereum valuable. And what's really valuable about it is if you get 32 Ethereum, you can take part in collecting fees on the transaction. So I dollar cost average into Ethereum. I don't trade it. On all of these things, all you can do is try to technically trade them because nobody knows what their fundamental value is. We know that it's up in the long term, but then it's going to flatten out. But with Ethereum, if I accumulate 32 and I'm on my way, I can take part in being a validator. Now I'm going to have some good computers, or I can lend out my Ethereum to other people who are going to do it instead, which is what most of you will do. You're not going to set up your own node, your own computer setup, server setup. What you're going to do is you're going to take your 32 Ethereum or less, and you're going to loan them to people who want to validate more transactions and contracts, and you'll get a really good interest rate for it. Right now, I think you're a lot of 6 and 7% interest rates. If it's real high, if you see something for 15 or 20%, you should question it. How stable is it? Am I going to get my Ethereum back? Anything that's too good to be true, be careful. But these are the two that I'd be real interested in. If Bitcoin on big corrections, just dollar cost averaging into Ethereum to get to my 32 units, because I do expect to set up my own node and processing at some point, if it's still viable at that point. I'm not rushing into this because I do think that there's big crashes yet to come. And then the weird side of transitory inflation. I know the Fed got rid of the word transitory on inflation, but it really is short term. We know that the big secular trend is deflationary, right? Everything is tied to demographics. If you don't believe the phrase demographics is destiny, then you haven't been studying. Demographics is destiny. The populations that are getting oldest fastest have the biggest problems coming because they end up having a huge obligation to their retirees and fewer people to pay into the system to support them. Japan has been buying its own debt for 20 years now, right? They've been almost constant QE. So when people say, well, Japan owns most of their own debt, so they're okay. No, because at the margin, they still have to be able to issue new debt. Japan had better take a lot of the financial business from Hong Kong, but I'm not positive that'll happen. So if you've been reading the news, they're getting very anti-foreign labor. So I don't know that Japan's going to actually win that game as much as maybe we thought a year ago. They're having a social pushback. Maybe it is Singapore. Maybe it's a little Australia. Maybe it's just a little bit everywhere. Takes some of that Hong Kong business. And then it becomes a company-to-company investment. Berkshire Hathaway bought 4, I believe, Japanese brokerage firms, their stocks. So for the average person, are you going to try to buy the stocks yourself? Or do you just say, well, Berkshire Hathaway is something I should have in my portfolio anyway. I'll just get my exposure through that or one of my ETFs. Good asset allocation is going to be most of how you make your money. And then any outsized returns will be the stock picking, which is why I tell folks about half in ETFs, about half in stocks is probably a great approach. Or even 3/4 in ETFs is just fine. And then you add your juice by picking out the stocks. In any case, the upside of transitory inflation is that, when we went to Costco last night, we saw some prices we never expected to see at Costco. And I was like, well, I guess I'll buy more toilet paper, just in case. They had a lot of toilet paper yesterday. And that's bad, right? That you're paying more for your goods and services. But that'll come down soon. And not really come down from the standpoint of we'll see lower prices across the board, but certain things will come back down. But then the prices will become kind of sideways again for a long time, like we've had. So we've had low inflation for a very long time. Again, that's driven by the demographics. It's deflationary. The high debt isn't that big of a deal, but the demographics and, of course, the disinflationary impact of technology, there's not a lot of things that have to go up in price. We have most everything we need from a material standpoint, and in the post-oil world, or in the energy self-sufficient world, oil was the cause of most inflation. Still is. As that impact goes away, as that becomes not that big of a deal, 5, 6, 7, 8 years out, as the demand for oil falls and those with oil assets panic produce, try to have it not be stranded in the ground, right? They'll start taking lower prices at some point, which is going to be really bad for frackers. Now you take a look at the equation. Okay, well, if we're at 30 to 40% of the new energy on the grid being solar by the end of the decade, which is probable. I don't know that we'll get the half. Yeah, I was thinking we might, but probably 30 to 40%. And realize 90% of new electricity demand, 90% over the last 5 years, has been satisfied by alternatives. That's just a fact. So there isn't this big demand push into natural gas or coal. It's short term right now. And that's going to dissipate quickly, 2-3 years out, not 10, 2 or 3. There's enough supply out there. There's enough alternatives coming that these firm prices in oil, gas, and coal just not going to last. So as our cost of living levels off, what is left of the inflation? Higher asset prices probably, but higher wages. Wages are sticky. So with sticky wages, unless there's a big recession like 2008 style, wages don't really go down. Now they can go sideways for a really long period. We saw that too, right? From Ronald Reagan to George Bush, wages basically went sideways. They ticked up a little bit under Obama, a little bit under Trump, and now they're really ticking up now. So if we're at a higher wage level across the board, and then the cost of living flattens and comes down in spots, particularly in housing, that's good for the average person. I talk about housing in here. There's a whole section on REITs. So I do think you want to read up on that, right? The REIT sector, especially on the residential side, is going to be weak. Why is that? Because there's a huge amount of new homes coming onto the market the next 2 years. Unless you can convince Americans to let 50 million people into the country over the next 2 decades, we're going to go from a housing shortage to plenty of housing a few years out. So as good as big immigration would be for America to keep us growing, to offset the labor shortage, which is probably not going to get much better for a while. We've got about 10 million people and 10 million jobs that are mismatched right now. So the people who are out of the workforce really need better skills to get into the workforce. We can fix that over time if we want to. From both sides, people have to be ambitious enough to get the education and skills. I know, there's a million millennial men who've just never really worked full time. I'm losing hope in them. 5 years ago, I thought that they would have gotten in by now. I mean, it's that million millennial men who were given the whole millennial generation, some bad looks from the boomers. But really, the millennials are doing most everything right. I got to be honest. They're investing early. They're investing more as a percentage of their income than any other generation. They're trying to move up the corporate ladder. They are doing what they like to do in many cases. I think more than past generations who just got a job, and they're seeing the world. They're trying to get circumspect. I gotta tell you, I'm fairly impressed with the millennials. I will say there is some interesting ethical issues there in the way that they fight the system. You take a look at how Reddit works, and it's basically collusion. Everybody hates that hedge funds do it. So rather than asking the SEC to fix it, they just fight with them. And technically what they're doing probably isn't legal by colluding to drive stocks up and down. But it is the nature of the beast. It is the crowd effect influenced by easy communications. So will it change? Probably not. They're going to keep having that big impact like I talked about earlier. Over here on the REIT side again, those residential REITs are going to be in a world of hurt, I think, with a little bit less easy money and a market with more supply growth than demand growth. And I don't know when that crossover happens, but it'll start shaving into margins. And you have to remember that most buildings need a lot of work. They have to become more sustainable. There's probably going to be laws on the books soon enough that require them to produce some of their own energy. So if you have a certain amount of rooftop, it's going to go from optional to somewhat required that you throw some solar up there. And you're already seeing a lot of companies do that, right? Amazon, Walmart, Kohl's, Google, go right through the list. There's a lot of big companies already doing it. And pretty soon the mid-sized and small companies are going to be told, produce some of your own energy. And that's going to be really good for solar. So all these big secular trends that are happening, you take a look at the cycles within the trends. And if the secular trend is up, you get your sine wave in there, buy the dips. And if the trend is down, your sine wave, right, your wavy part of the market, you sell the rips. So this big rally in oil stocks that has already started to turn over. I told people a few months ago, sell into the oil stock rally. The people who were bullish on it told me I was wrong. Said I was wrong to get out oil stocks in the first place. Well, but I bought PBW and TAN and SunPower and had Enphase for a while. Relative performance, folks. At the end of the day, that's why you do a forecast. Try to figure out where the big opportunities are, figure out where the risk is the greatest so you can avoid it. And then you make your tweaks and your adjustments along the way. Just an announcement, I will be doing the money show in 2022, 4 or 5 appearances it looks like. Keep an eye out for that. And then obviously read me on Seeking Alpha. This is all my free work. So follow along. I think that we've got a big transition year coming. The new plug and play lists, there's 4 or 5 new stocks on both lists, on both the dividend list and the growth list. And then the ETFs will be updated probably a week after that. All right, everybody have a great new year. Stay safe.